Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. The semiconductor supply chain is experiencing a structural earthquake that's reshaping sector rotation in real time. This isn't a temporary hiccup. It's a cascade of bottlenecks moving through the AI infrastructure stack, and traders who understand the sequence are repositioning ahead of the next wave. Pat Gelsinger nailed it when he said chip supply chains will shape geopolitics more than oil over the next 50 years. That's not hyperbole when you look at the data. According to a comprehensive report released in June 2026 on bottlenecks to scaling AI computational power, we're seeing sequential constraints hitting the semiconductor supply chain in three distinct phases. Phase 1 was the GPU shortage between 2023 and 2024. NVIDIA, ticker NVDA, and AMD, ticker AMD, couldn't produce enough graphics processing units to meet exploding AI demand. That bottleneck created the initial supply shock. Phase 2 is happening right now. Memory chips, specifically DRAM, NAND, and critically, high bandwidth memory, known as HBM, have become the primary constraint for 2025 through 2026. Industry commentary cited by Silicon analysts indicates the HBM shortage has shifted from a temporary bottleneck to a structural supercycle. This is the constraint choking AI server deployments today. Phase 3 is already visible on the horizon. By 2027 through 2028, grid energy and infrastructure are projected to emerge as critical constraints for the data centers powering AI. The cascade continues. Now let's talk about what this means for capital flows and sector rotation. Q1 2026 S&P 500 earnings growth surged nearly 30% compared to prior estimates of 13%. That's a massive beat, driven substantially by AI infrastructure spending. Data from the June 2026 report shows some segments within data centers and tech equipment recorded up to a 43.4% quarter-over-quarter increase in spending. Here's the headline number. AI companies in the United States now account for approximately 23% of total capital expenditure across the market. That's an extraordinary concentration of capex in a single thematic, and it signals where institutional money has been flowing. But that flow is starting to encounter friction. TSMC, ticker TSM, holds roughly 90% market share in advanced semiconductor nodes. The company reported Q4 2025 revenues of $33.73 billion. For Q1 2026, TSMC forecasted sales in the range of $34.6 billion to $35.8 billion. And the company has planned capital expenditures of approximately $52 billion to $56 billion in 2026. Those are massive numbers, but unprecedented AI chip demand is pushing TSMC's capacity to its absolute limits. According to analysis from Tom's Hardware, nobody's scaling up capacity aggressively. The industry remains conservative on capacity expansion despite demand signals. That's creating liquidity constriction for advanced packaging and high bandwidth memory. NVIDIA and AMD, the two names synonymous with AI-driven data center deployments, are now facing supply constraints that are forcing investors to question the sustainability of overdependence on these high-margin, AI-dependent cloud plays. On June 5, 2026, shares of AMD and Intel, ticker INTC, experienced notable declines. According to Kavut's market lens analysis on what triggered the recent semiconductor sell-off, caution grew around the AI chip outlook as deepening memory chip challenges compounded existing supply concerns. This is where sector rotation gets interesting. Investors are shifting from heavy AI and cloud-dependent stocks toward legacy chip manufacturers and defense contractors as a diversification strategy in light of supply uncertainties. The rotation isn't about abandoning the AI thesis. It's about repositioning around the constraints. Legacy chipmakers who produce a diversified mix of components, not just cutting-edge AI accelerators, are getting a fresh look. Defense contractors with semiconductor exposure are also attracting attention because their production capabilities aren't as exposed to the vagaries of AI chip supply allocation battles. The supply chain constraints are rippling beyond the chipmakers themselves. Earnings forecasts across multiple sectors are being recalibrated as chip allocations for data centers tighten. Companies that depend on AI infrastructure for growth are seeing their outlooks adjusted downward based on component availability rather than end market demand. That's a critical distinction for traders trying to separate demand-side weakness from supply-side constraints. From a macro perspective, these bottlenecks are starting to influence Federal Reserve policy considerations. Inflation and growth data are beginning to reflect the knock-on effects of semiconductor supply constraints. If AI infrastructure spending is driving economic growth but hitting supply ceilings, that changes the growth trajectory embedded in Fed models. There's also a recalibration happening in the correlation between technology spending cycles and crypto markets. Bitcoin, Ethereum, and other digital assets have historically tracked tech sector momentum. But as investors search for less volatile, less supply-constrained assets, those correlations are shifting. Some capital that would have flowed into high-beta semiconductor plays is rotating into alternative assets. Let's zoom in on the high-bandwidth memory supercycle because this is the current choke point. HBM is essential for AI servers. It enables the data throughput required for large language models and AI training workloads. The suppliers of HBM, primarily SK Hynix, Samsung, and Micron Technology, ticker MU, cannot scale production fast enough to meet demand from NVIDIA, AMD, and hyperscale data center operators. According to the CNAS report titled "American AI Companies Can't Get Enough Chips," the shortage is structural, not cyclical. Memory fabrication capacity takes years to build out, and the specialized nature of HBM production creates additional barriers to rapid scaling. This is a multi-year constraint, not a few-quarter hiccup. For traders, the actionable insight is this: the companies that secure HBM allocation will outperform, and the companies that don't will miss numbers. Earnings calls over the next 2 quarters will be dominated by discussions of component availability. Listen for management commentary on memory allocation and advanced packaging capacity. Those are the real margin of safety indicators. The data center chip market is projected to continue growing, with forecasts from Persistence Market Research highlighting strong demand through 2033. But growth rates will be gated by supply, not demand. That's a fundamental shift in how to model semiconductor revenue and earnings. Another angle to watch is geopolitical risk. As Gelsinger's quote suggests, semiconductor supply chains are becoming as strategically important as energy supply chains. TSMC's dominance in advanced nodes creates concentration risk. Any geopolitical disruption around Taiwan would send shockwaves through global markets. Diversification efforts, including TSMC's Arizona fabs and Intel's domestic production expansion, are still years away from meaningful capacity contribution. The rotation we're seeing in Q3, 2026 reflects a market that's pricing in these structural risks. High-flying AI-dependent names that dominated 2023 through early 2026 are consolidating or correcting, while diversified semiconductor plays and defense contractors are gaining relative strength. This isn't a sector crash. It's a rebalancing. Bonds are also responding. If semiconductor supply constraints slow economic growth or create stagflationary pressures, that changes the yield curve dynamics. Treasury markets are starting to price in a more complex macro scenario where growth slows but inflation remains sticky due to supply-side constraints in critical inputs like semiconductors. Crypto markets are watching this closely too. Institutional adoption of Bitcoin and Ethereum has been partly driven by tech sector capital flows. If those flows redirect towards supply-constrained physical assets or legacy industrials, crypto could see volatility. Conversely, some investors view digital assets as a hedge against concentrated supply chain risk in physical goods. The bottom line for traders is this: the AI infrastructure build-out is real, but it's hitting physical constraints that are reshaping valuations and sector leadership. The companies that navigate these bottlenecks, secure component allocation, and diversify their supply chains will be the outperformers. The companies that can't will disappoint. Watch TSMC's quarterly guidance closely. Watch memory supplier earnings from Micron and SK Hynix. Watch NVIDIA and AMD for commentary on component availability. And watch the legacy chip makers and defense contractors for signs of capital rotation. This is a structural shift, not a cyclical one. The semiconductor supply chain earthquake is reshaping how capital flows through tech, industrials, and defense. Traders who adapt to the new constraints will outperform those who cling to the old playbook. That wraps your market intel. Trade smart out there. For deeper insights and real-time analysis, visit capitalcopilot.io.